So it qualifies for a 1031 exchange.
Mhm.
So you do a 1031 exchange on it. But you take $500,000 in taxable boot. Remember, we talked about being able to do a partial exchange
Yeah.
and taking some of the money out taxable. But in this case, because on that same property, you actually lived in it for 2 out of the 5 years prior to selling it, that $500,000, which would normally be taxable, is tax free because what you're getting to do is take advantage of both statutes. You get the 500,000 tax free under 121. You get the other 500,000 tax deferred under the 1031.
Are you looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted Patel.
Hey everyone, this is Ted Patel, and welcome to this week's edition of Decoding Cash Flow Podcast. Our topic today is 1031 exchange. It provides the opportunity to defer tax by swapping one investment property for another. However, 1031s can be very tricky. So we have our guest, Dave, joining us today to explain details of 1031 exchange. He's a qualified intermediary for 1031 exchange and the founder of the 1031 Investor. He has over 25 years of experience working in all phases of real estate investing, including the 1031 as well as SEC 121 primary residence exclusion. So Dave, welcome to Decoding Cash Flow. It's a pleasure having you here.
Thank you, Ted. It's awesome to be here. Boy, you said that word right. However, is a very, very big word when the IRS is using it, isn't it?
Yep, absolutely. A little mistake here and there, and you're done. You know, your all 1031 exchange goes in air. So you got to be very careful. Absolutely. So Dave, before we dive deep into the details of 1031, right? If you can give our listeners a little bit more background about yourself, how did you get started in real estate? And of course, I know you are a QI as of right now. What else you do in
Sure.
addition to QI? Yeah.
But actually, my 1031 story of being a QI is part of the story of how we came to be real estate investors.
Mm-hmm.
And, it was the mid 90s. And my wife and I we had our first child. And we realized that life was too busy and having two careers and a child. And the greatest commodity we have is time. And we were going, okay, we don't want more money. We don't want more fame, more prestige. What we really want is more time. How can we do that? And really, the only way to do that, if you're giving your time to an employer, you're giving away your most valuable thing. So we had to take control of our own lives. And I don't know, somebody just threw out the words, let's become real estate investors. It'll be easy. And so from there, we all went downhill quick. But what we did was, that was exactly it. We decided that we wanted to buy a sailboat and sail away and raise our kids. Simple enough, right? So, because my other nickname is Ready, Fire, Aim Dave, I
Okay.
just went and bought a duplex in Denver. Bought a duplex, fixed it up, put renters in it. A little bit later, I sold it, made a ton of money, and just thought, how much harder can this be? Really, I'm an expert. Until my accountant pulled me aside that January and said, "Oh, by the way, you owe the government $30,000." That just did not seem very fair at all. And that's when I went, because $30,000 is a lot of money back then.
Yeah.
And that was going to throw the timing of our sail away plan just all the heck and gone. So I started looking for another way. And right at that moment in the mid 90s, there was a huge court case. I'm an accountant, so I'm a nerd. I read the articles. Yeah.
Mm-hmm.
there was a court case settled that was going to allow this thing called the 1031 exchange to be used by regular investors. And what it would have done for me is allowed me to sell that property and go and buy new, more, bigger investment property using that $30,000. And then I get to make the income off of it. Now you think about that income off of $30,000 could be $3,000 or $4,000 a year. That's no small feat.
Just take into account the compounding of 30,000.
Compounding that, yeah. If I would have that today, 30 years later, yeah, we'd be a different story. But finding that and discovering that changed the game for us. And so we immediately embarked on that. And I had some good friends that said, Dave, this is going to change people's lives. Let's start a business. So I went into business with them, doing the 1031 exchanges for others. And 10 years later to the day, we were able to sail away on a 53-foot sailboat paid for by tax-free dollars. And we lived for 10 years off the rental income from our portfolio of vacation rentals. All in 10 years. We managed to do that because we never had to pay a penny again of tax or depreciation recapture. And then here we are 25 years later, still doing exchanges for others. So it's something that's kind of in my blood at this point.
Awesome. All right. So, of course, I just gave a one-liner of the 1031 exchange while we got started, right? Deferred tax by swapping one investment property for others. For our viewers, if you can give a little bit more detailed step-by-step process of how to do 1031, that'll be great.
That's kind of the beautiful thing about this, Ted, is although there's some very specific things that I'll mention in just a second, the process itself is exactly the same as normal. You put a piece of property on the market, you get a contract to sell it, you close the sale, then you go and you buy new real estate. You don't act any different, which is beautiful. So you're not adding to your workload. But here are the things that are unique that have to happen. You can't do a 1031 exchange by yourself. You have to use an unrelated third party called the qualified intermediary. That's who we are. And we have to be involved prior to the closing of the sale. So what happens is there's a lot of extra documents that are part of the sale when it happens. And then the IRS does not let you touch the money. The money has to go into your exchange account with the qualified intermediary while you're shopping. So that's two things that are different, but they don't add to your process. They just are things you have to think about to make sure are in place.
Yeah.
Now, from the date of that closing of the sale, you've got 45 days to identify your potential replacements. You have 180 days to complete your purchases. And as long as you purchase at least as much real estate as you sold, your net sale, and as long as you use all of your cash proceeds to do it, you'll defer all tax indefinitely. That's the key word.
Yeah. And just in case, if you don't buy, let's say you sold the property worth 500K, whose basis was 2,000K, right? Cost basis were 2,000K. And you only invested 400K. So the 100K will get counted against your capital gains. Am I right?
Yeah, that's what we would call a partial exchange.
Yeah.
So the entire gain, and we're just ignoring the depreciation recapture for a minute, but your entire gain would be 300,000. If you buy 100,000 less than you sell, you pay tax on the difference.
Yeah.
But you would still shelter the tax on the other 200,000. Yeah. So strategically, that can be a very good thing to set up and do. Yeah. Or you could buy multiple properties in what's called a diversification exchange. Okay. So you sell one property for 500 and you go and buy two for $250,000 each. Mm-hmm. Or one for $400,000 in cash, and then another property for $500,000, using the other $100,000 as a down payment.
Mm-hmm. Okay. All right. And you got to identify both the properties, as you said, within 45 days. Okay.
You do. Now, the key to there, and that can be a very scary thing because 45 days isn't very long, is it?
Yeah,
especially in seller's market, right?
Mm-hmm.
So it's a couple keys that we will tell people to help them. Number one, you can be under contract for your new property anytime you want, even before your old property closes. You only have to close the sale of your old property before you take title to your new property. So a lot of our clients will actually be under contract for their new property so that they close the sale and then a week later they close the purchase. That eliminates some of that 45-day risk, but also something that people don't think about, that gets you to restart your cash flow that much more quickly.
That's true.
Because your money is not just sitting.
Mm-hmm.
Another thing that I'm fond of telling people is look at what the market is telling you. If it's a seller's market, do the hard thing first, which is find your new property and get it under contract. If it's a buyer's market, wait until you've got a sale scheduled before you look, because the hardest thing is going to be to get that property under contract. There'll be a lot of options to purchase. Back about, oh my gosh, it's been long, 3 or 4 years ago, when California was just hotter than a firecracker, right? And everybody was trying to get into the California market. We would have investors that there's no way I can do a 1031. And I would tell them, don't even put your property on the market. Grab whatever cash you can and put it down on a property, not contingent. Just put it down on a new property. Release the earnest money if you want. It's not going to matter. And so they would actually get their new property under contract before they even listed their old property. And then as soon as they had the contract, I'd say, now go list your property. They'd list it. They'd have 17 offers above asking on day one, all cash with a close of 10 days. Whatever the market tells you, take advantage of.
Yeah.
And that'll help with that 45-day period.
Yeah. So that's a really good advice, because sometimes what happens is people, they put their property on the sale and they're not able to identify the new one, and they can either keep dragging the closing of their old property, or maybe let the sale go away, just break the contract or whatever it takes.
Right. Now, all of that being said, though, the 45 days is actually a little scarier in perception than it is in reality. So when you think about 45 days, it's 45 days from the closing of your sale. But if you've got a normal 45-day closing, that adds another 45 days. That's 90 days. 3 months to be able to find your new property. Most people can do that.
Yeah.
It just feels scary because at the end of day 45, you're stuck and you can't change your list. So it's designed to feel scary, but the reality is 95% of our clients complete their exchanges just fine.
That's great. Now, in this 1031 exchange, what are the things that investors need to be very careful of? Okay. Like check mark these boxes. You have to do this to do the 1031 exchange. Anything is specific?
Yeah, I mean, first and foremost goes back to you've got to have the QI in place before the closing of your sale. Yeah. That's absolutely so critical. The second thing is monitoring those time periods, because there are never going to be any personal exceptions or exemptions to those.
Yeah.
Now, I would say the next biggest issue that people get into is not understanding the reinvestment requirements, which are that in order to defer all tax, you have to do 2 things. You have to purchase at least as much real estate as you sell, and you have to use all of your proceeds from the sale in the purchase. A lot of people think, oh, I only have to reinvest my profit because that's the only thing I'll be taxed on. That's kind of true, but the IRS defines it differently. And so what they say is if you're going to do a 1031 exchange, we're expecting you to leave all of your capital in as well if you're expecting us to leave our tax in. So what they do that is they say that any amount of cash you take or any amount you purchase less than you sell is going to be considered taking profit first. So you and I would say, well, I'm going to take my $20,000 original capital. The IRS says, no, you're not taking that. You're taking profit, so you're going to pay tax on it.
Yeah, that's right.
So it's not fair. It's not right, but they've got nuclear launch codes, so I'll give it to them.
Yeah. And the other thing is, in addition to what you said, right, for our listeners, like, it's not only restricted to buying real estate. You can invest in many other assets, maybe oil rights, land rights, in addition to all the different kind of real estate property.
That's actually a very interesting, take. There's one clarification on that, and that is that it does have to be real estate. Now, the reason why I say that is because prior to 2018, we could do 1031 exchanges on heavy equipment, airplanes, restaurant equipment, things like that. That all changed in 2018. Now it is only real estate. But you're absolutely right. There are a lot of things that are considered to be real estate that you wouldn't think of. For instance, oil and natural gas rights are considered to be real estate. Cell towers with 30-year leases on them are considered to be real estate. When we moved onto our boat, and we lived in Key West, and you'll have to, you tell me if you can figure out how I made this work. I had a client who did a 1031 exchange and bought a piece of real estate in Key West, and we lived on our boat on his real estate. How did I do that?
Okay. That's awesome. Wow.
Because what he bought was a boat slip. And a deeded boat slip. So in many states, Florida, South Carolina, California, if the boat slip actually has a deed with the county tax collector and appraiser, it is a piece of real estate. So you could sell a condo in Ohio and buy a boat slip in Key West. Or like he did, he sold a pharmacy in Florida and bought the boat slip. And then I rented the boat slip from him. So it was an investment property. So deeded boat slips, deeded timeshares. One popular movement out there right now is the condotels, where they're centrally managed, but you own an actual unit. So it's not really a timeshare. You own the whole unit, but it's all centrally managed. Those are real estate for 1031 exchange. So there's some things that can be pretty fun to play with.
And of course, the sequence of closing or selling your property, identifying a new one, and buying a new, property in exchange. How about the otherwise? Like, you want to sell a property, the reverse 1031. Can you just give a little bit more information on how would that work when you have sold the property? You have bought the property, but you still have to, the sale is still pending.
Sure. It stems from the statutory requirement that you cannot take title to your new property before your old property closes. So knowing that that's a hard and fast rule, how can we do it the opposite way? And it's called a reverse exchange. What it doesn't do is it doesn't reverse that process. You still cannot take title till after you close the sale on your own property. But what happens is that we, as the qualified intermediary, will take title to the new property instead of you.
Okay.
So you have control of it. You make all the money off of it. You have the use of it, but you don't own it. We own it. And we can hold that property for 180 days while you get your other property sold.
Okay.
And then once your other property sells, you use those proceeds to take title to the property that we're holding. And that's how it can work with sort of reversing or using a reverse exchange.
But does a bank is okay to provide the loans on those reverse transactions?
Lending can be a little bit tricky because a conventional lender is not going to be able to do it because they're being asked to lend money to our entity, which is a new entity. We form them fresh for every purchase. It's a new entity, and we have nothing to do with the property other than just being on title. But it's being guaranteed by the client, and the client's guaranteeing the loan, but they're not a member of the entity. So conventional lending is never going to work. There are a lot of local banks and portfolio lenders that keep their loans in-house and don't sell them. And those types of lenders can do the reverse exchanges. Generally, it ends up being either a private loan or a hard money loan or cash from the client's own pockets.
Okay. All right. That's good to know because, or maybe you can just buy it cash, right? It doesn't matter. You can buy it cash and then put it in the escrow of the QI.
Exactly. Yep. Exactly.
Okay. What are the main, or maybe I would say, during your whole career, right? 20, 25 years. I'm sure you might have seen many complicated transactions. Can you tell listeners about one of the complicated transactions, the hardest thing or complicated thing that came across, and what was the resolution for it?
Well, early on, I haven't done one of these for quite a while, but early on, we did what was called a multiple party exchange, where we all sat around a table and the same piece of property exchanged hands like 8 or 9 times to finally end up with the ultimate buyer. And that one in particular didn't require anything extra other than some cash. But there actually used to be a day back when West Texas ranch land, which is like the least valuable land in the world, some of that would be used to fill in the gaps of a 1031 exchange so that the valuations could work. So they would swap properties, but one property was less valuable than the others. So they would add into that 25 acres of West Texas land to make the values work right. Crazy kinds of stuff when it comes to valuation. But I almost said this is a really fun one, but it's not. It wasn't for the client anyways. Remember how we talked about the 45-day period being so important? Well, this client of ours just this last year he sold his property. He identified a whole bunch of small lots that he was going to build multifamily properties on and then manage them. He identified a bunch of them on his 45-day list, but he neglected to have them all under contract. Day 45 came in the next 30 days. He only ended up getting a contract on one of like 9 properties. Well, he's stuck at that point, isn't he? Because those are the only properties he can purchase. So I was feeling really, really bad for him. He said, "What can I do?" I said, "You can go talk to the people that outbid you." And that's exactly what he did. He went to the people that outbid him, gave him a few $1,000s more. So they, in essence, made a profit on
just letting the property go without doing any transaction.
Exactly. And he ended up, though, being able to shelter a whole bunch of tax. So it was important to him. So those are some of the pitfalls that can happen.
And talking about multiple partners, that brings me to one other question. let's say in a property, there are two partners. It's an LLC, under LLC, two partners. And now they want to sell the property, but both partners want to go separate ways. How
Sure.
would we handle that?
That's actually a very, very common scenario because in America, we love the protection of the LLC and how it can be used as an operating agreement and everything. So it makes perfect sense. The problem is that an LLC with more than one member has to file its own tax return. And that tax return reports the activity of the real estate. So the owner of that real estate is the LLC, not the members. The members don't own real estate. They own a membership interest in an entity that owns real estate. So there's no 1031 for them to do. So what do we do if they want to separate? They have to do one of two things. Either the LLC could sell, and then the LLC could buy two properties, one that each one of the partners picks out, completes its 1031 exchange, and then they dissolve the LLC and distribute the property, each of the properties, to the member that wanted that one. And each one of them goes on their way. There's no tax that's due because the LLC deferred all the tax, and simply distributing property from an LLC to the members is not a taxable event. So that's one way to do that. Problem, obviously, as you can see right from the front, how do we manage to make it absolutely fair? Someone gets a little more expensive property, someone gets a little bit less, nobody's happy. And so many times these are kind of contentious anyways, because there's a reason why they want to get apart. So over the last 20 years, the opposite way of doing it has started to come more and more into favor. It's what we call a drop and swap, where right before the closing of the sale, the LLC dissolves itself and distributes the property to each of the two tenants, to each of the two members. I'm sorry.
So one property to two. So from LLC's name, it goes to the personal name.
Exactly.
Okay.
Now they own it as tenants in common. So each one of them owns their own piece of real estate. And so now when they sell, each one of them can take their percentage and go buy a different piece of real estate with their own 1031. So it doesn't take any cooperation. There's none of that. The one drawback to this over time was the fear that the IRS was not going to like that. Because one of the things that's required is that you have purchased the property with the intent of holding, excuse me, that you purchased the property with the intent of holding for productive use. And the transition from the LLC to the members, they really just took title to sell it. So they got to put that into question. But over the last 10 or 15 years, there's been some favorable rulings, particularly with trusts, including Delaware statutory trusts, where now they're saying that a fractional interest in an entity that owns real estate can be, in certain circumstances, considered to be the same thing as owning the real estate. So the transfer from the LLC to the former members accomplishes that.
Okay, right. So now, in the syndication process, many of the syndicators or operators, they do take 1031 exchange. So those individuals coming in as a 1031, can they go out once the property's dispositions? Can they go out and buy another or invest in another property with the 1031?
As long as they have not ended up contributing their property back to the limited partnership, yes. Because in order to 1031 into a syndication, they're actually buying a piece of the property as a tenant in common with the syndication. So if it stays that way, and then the syndication goes to maturity and sells, then there's actually two sellers of the property. There's the syndication and there's the 1031 investor. And so absolutely they can go ahead and do another 1031 exchange. Now, if they've contributed their property to the partnership, they no longer own real estate. They now own part of an entity that owns real estate. And we get back into that same ownership entity, same ownership issue.
The same entity can go by another.
Yeah. So if they contributed their tenant in common interest to the LP, now the LP is who owns the real estate. The investor no longer owns real estate. So the LP could do a 1031 exchange, but not the individual investor. And a syndication where there's many members like that, and ownership and management is vested in a small number of people, is never going to qualify to do a drop and swap. Okay. So people do want to be careful when they're going into syndication as a 1031 investor to make sure they can get back out, because otherwise they've wasted their tax deferral at that point in time. And what I have counseled people many times to do, people who want to go into syndications but can't seem to find a way to 1031 into it, do a cash out refinance. Here's a great example. Okay? We've got a client who sells a property for, say, $500,000. And he's got $200,000 in a loan on it. So $300,000 in cash come out. Well, he's going to take that $300,000 and he's going to buy two properties. The first property he's going to buy is for $250,000 cash. He owns it free and clear. The second property, he's going to take the other $50,000 and he's going to buy another property for $250,000, using that $50,000 as a down payment. So did he purchase $500,000? He sure did. Did he use all of his proceeds to do it? Yep, he did. So he's completely deferred all tax. Mm-hmm. But now what he has is a property with no debt for $250,000. Mm-hmm. And so what he could do is an immediate cash out refinance. Take that $200,000, which is now tax free, and use that to go invest in a syndication.
Or maybe buy a third one.
Or buy a third one. That's exactly right. Yeah. Without the constraints of time, because he's satisfied his exchange. And so now he can wait until he finds just the right property. Mm-hmm. And it's not costing him any money in the meantime.
Yep. All right. That's really awesome. So many different benefits. Of course, the tax deferred benefit is the best one, right? And so while we were discussing, right, the other details, you brought up Delaware statutory trust. So can you tell us something more about it? How is it different from 1031? And when can people use that?
Yeah, Delaware statutory trusts actually are simply a different form of replacement property for a 1031 exchange. Most of them require accredited investors or sophisticated investors. There's a difference in qualifications and such. But the key to all of them is that you don't own the real estate directly. Instead, you own a fractional interest of a trust, and the trust owns the real estate. And it only qualifies with a particular kind of trust formed in the state of Delaware. That's the only magic of it. Because I know it sounds like a syndication, doesn't it?
Yeah, it does.
It's exactly like a syndication. But because it is the trust that's formed in Delaware, the IRS officially blessed these in 2004 as suitable replacements for a 1031 exchange. So you could sell a piece of property and purchase shares of a Delaware statutory trust as your replacement and continue to defer all tax. They are a great opportunity if you are wanting to start to move from active to passive investing. They're a great opportunity if you're struggling to find a good replacement and you need something that's readily available. They typically don't pay as much as you can make if you're managing your own real estate. But you got to balance the effort there, right?
Yeah.
To do that. They generally don't make as much as syndicators promise.
Mm-hmm.
I use that word promise.
Yeah.
Just because you don't know. But
Yeah.
they're very, very honest about what they do provide. So some people get hung up on that. Come on, you mean I'm only going to make 7%? Well, you're going to make 7%, but you're going to make that. But because it's a real estate investment, you also get your share of the appreciation, of the depreciation, of the amortization of the loan, just like any other type of real estate.
Mm-hmm.
So your internal rate of return, which is the most important metric for real estate ownership, usually is still well above 12%.
Mm-hmm. And how difficult is to dissolve your interest in this DST, take the money out and put it in the other property?
That's the other downside to these, is there's no liquidity at all. Basically, once you buy them, you're at the mercy of the sponsor, which is just another name for the syndicator. The sponsor already has determined how long they think they're going to hold it. And generally, they're 3 to 5 years. What they've done is they bought the asset or they built the asset. They stabilized it. Then they sold shares so they could get the cash to do their next project while this one waits. And they're factoring that probably in 3 to 5 years, they will then sell it to something like the Minnesota Firefighters Union, a big pension fund kind of thing. So you're stuck holding that until they sell. But when they sell, you do have the option of 1031 exchanging into any other DST or back into real estate. And that's what a lot of my clients are doing right now, is they're moving into DSTs just as a placeholder.
Mm-hmm.
And they're saying, Dave, last year they were starting to do this. Dave, I'm going to bank on 4 years. And by the time this sells, interest rates will have come back down. And now I'll be able to start buying in the open market.
Got it. Okay. All right. So now, like for the investors who want to do 1031 exchange, right? What are the things that they need to look into while selecting a qualified intermediary?
So, yeah, that's an interesting question, because the word qualified in the name qualified intermediary doesn't mean anything. All it means is that you are qualified. And by the way, I can't make this up. This is actually in the IRS statutes.
Yeah.
You are qualified if you are not disqualified. And the only thing that disqualifies you is if you have a family or business relationship with the client.
Mm-hmm.
So basically, the dog groomer down the street could be your QI as long as they don't take care of your dogs. So you just want to be careful.
Yeah.
Because it's very easy to set up a shingle and call yourself a QI. Now, that being said, I don't want to scare people. It's such a small little niche of the tax code that it takes a real nerd like me to go into something like this. So generally, the larger QIs in America, we are accountants, we're attorneys who just said, this is all we want to do. And so that's what we focus on. And that is something that you want, because while it's a small statute, it's a very deep statute and a dense statute. And you need to be working with a QI that's got enough of that experience and that desire to live in that world that they're going to be able to understand, as opposed to an attorney who does 6 or 7 a year or something like that. They could do them. It could probably be legal, but you're not going to get the breadth of experience. So I would say, if you want to vet them for experience, honestly, referrals and demonstrate a comp. That's the best way to go these days.
Okay.
If your friend has used a QI and they did a good job, they're going to be willing to tell you about it. And it's probably a pretty good bet that they're going to do a good job for you as well. Those are the two biggest ways. I kind of look at it, Ted, as like a Goldilocks sort of thing. You remember the story of Goldilocks and the Three Bears, where she broke in and one porridge was too hot, one was too cold, the other was just right. So with QIs, the bigger the QI is, the chances are the more experience they've got, the better they're going to be able to serve you, the cheaper they'll be because they've got economies of scale. But the bigger they are, the less you're going to have access to the key consultants to answer your questions. You're going to be talking to order takers and marketing reps. The other side of that, though, is the QI that's small enough that they can answer your phone calls all the time might not have the experience to be able to answer those questions. And you might pay more because they're only doing a few a year. So you want to find that QI that's experienced enough and big enough to give you economies of scale, small enough to give you personal attention. And they're out there. They're out there. You can find, I like to think that we've got some happy clients. So
normally, what are the costs for having a QI on an average?
You should be able to get a good 1031 exchange for less than $1,000. Now that alters a little bit as you go further to each coast, and usually that's just a factor of their cost of surviving. If they're in California, they're paying a lot more for office space, so they might be more expensive on each coast. And in the heartland, or down here in sunny Florida, where we don't have state tax, we can afford to pass that on. But yeah, $1,000 should get you a good exchange, just about anywhere.
Okay. That's good to know. All right, now had a lot of discussion on 1031. Maybe one other aspect I'd like to dwell into, because see, many of the regular people, they might not be an investor, but they own primary residence, right?
Yes.
So if a person wants to sell their primary residence, which had a more than 500K worth of capital gain tax as a married person, how would they swap their property with a new property without paying the capital gain tax on the primary residence?
You know what it sounds to me like, Ted? It sounds like you got the book that we sent to you and you actually read it. The book that I wrote. That's actually one of the more, if you don't have it yet, it's on its way to you. I know that. Yeah, I wrote a book last year called The Real Estate Lifetime Tax-Free Wealth, The Real Estate Investor's Guide to the 1031 Exchange. And this exact topic is one of the things we deal with, because Section 121 is the part of the tax code that deals with your primary residence. And what it says is that if you buy a property, move into it, live in it for 2 out of the 5 years prior to selling it, then as a married couple, you get to take the first $500,000 in profit tax-free. Do you know how many times you can do that in your life?
Every 2 years.
Every 2 years. I mean, think about that. If you took a job that you could work for 2 years and then quit, and all the profit from that is tax-free, you might be motivated to move a little bit more, wouldn't you? Well, this is exactly what we did to get to the boat, is we did that periodically because it's tax-free. Why would you not want to do that? The problem you define, though, is what a lot of people are in right now. They have more than $500,000 in profit. So they could sell and they'll take $500,000 tax-free, but they might have to pay tax on $500,000. That's not cool.
Yeah.
So the simple way to fix that is what's called a conversion. All you do is you move out of the property and turn it into a rental for a year.
Okay.
Now, maybe you rent it to friends. Maybe you turn it into an Airbnb when you go anywhere you want to live. It doesn't matter as long as you change that from your primary residence to an investment property. And then after a year, you sell it. Now, you're selling an investment property, aren't you?
Yeah.
So it qualifies for a 1031 exchange.
Mm-hmm.
So you do a 1031 exchange on it. But you take $500,000 in taxable boot. Remember, we talked about being able to do a partial exchange
Yeah.
and taking some of the money out taxable. But in this case, because on that same property, you actually lived in it for 2 out of the 5 years prior to selling it, that $500,000, which would normally be taxable, is tax free. Because what you're getting to do is take advantage of both statutes. You get the 500,000 tax free under 121. You get the other 500,000 tax deferred under the 1031.
Mm-hmm.
It's an awesome strategy.
Yeah. Because nowadays, after all this appreciation in the market, there might be many people who has more equities than they invested.
Now, you want to hear a really cool related hack that's just the opposite? So check
Sure.
this out. I'm getting close to retirement, so I start to position my portfolio. I mean, I maybe live in Kansas City, and I want to live in Sarasota, Florida.
Mm-hmm.
So a few years ahead of that, I start to sell my investment properties, and I do 1031 exchanges into really nice beachfront rentals in Sarasota. When I'm ready to retire, the last thing I do is I sell my house in Kansas City that I live in. Well, that money's tax free, right? So that starts my retirement. But where do I move? I move into one of my beachfront rentals and convert it the opposite way from investment into my primary residence.
Okay.
And then once I have owned that property for 5 years, once I have lived in it for at least 2 of the previous 5, I can then sell that one. And I get to take a proration of the gain tax-free. I had a great client that actually did this on St. Pete Beach.
Yeah.
Go
And
ahead.
you can also convert the same rental property back to investment property. Take 500K, move to other rental property. Can you do that?
Not quite. The IRS caught on to that one.
Okay.
So what they say now is when you convert a property from investment to your primary residence, you only get to prorate the gain.
Mm-hmm.
So my guy that bought 3 identical condos on the same floor, he moved into one. He lived in it for 3 years. So he rented it for 2 years. Then he lived in it for 3. Had he owned it for 5 years? Yep. Had he lived in it for at least 2? Well, yeah, he'd lived in it for 3.
Mm-hmm.
So he got 3/5 of the gain tax-free.
Okay. Got it.
If he would have lived in it for 8 years, he would have gotten 8/10 of the gain tax-free. So the IRS makes you pay a little bit of price, and you do have to recapture depreciation. But when he did that first time, do you know where he moved?
Where at?
To the second property next door.
Uh-huh.
And it did the same
thing. Mm-hmm.
So it's a great strategy for retirement to actually start to eliminate some of that tax. You're not going to get rid of all of it. Far and away, the best way to eliminate tax, and it's not my favorite, but it works every time, is to die. Because when you die, your heirs get your property at a stepped up basis. So the tax that you owe disappears and they get your properties tax free.
That's true. But you are no longer there to enjoy that property.
No, you're sure not. So I would delay that as long as I could. But it is kind of cool because it gives you the opportunity to do what a lot of people say, swap till you drop, defer, defer, and then die.
Yeah.
There are literally a dozen ways that you could use the 1031 exchange to never have to pay a penny in capital gains tax as long as you live and after you die as well.
Yeah. All right. Hey, Dave, loving this conversation. It's so much detail, so insightful. But, just want to be respectful of your time also. Would like to move on to the final round of questions. But before we go ahead, is there anything else you'd like to tell to our listeners?
Well, you know what? I think certainly we'd love to consult with people. 1031, as you mentioned, it's such a deep statute. And there's so much that you could flesh out of it. But it's almost like people don't even know the right questions to ask. So we've developed a branding that's really focused on education. The book, which I mentioned, Lifetime Tax-Free Wealth, the 1031 and the Real Estate Investor's Guide to the 1031 Exchange, our YouTube channel, which has over 60 short videos, all designed to help you shape your strategy. And of course, our website, the1031investor.com, where you can access calculators, articles, talk to us. We want to do your 1031 exchanges, but more importantly, or as importantly, we want you to be successful using them.
That's true. Yeah. You want to get them educated so they can, get the best out of it. All right. So moving on to the final round of questions. Dave, are you ready?
Let's go for it.
All right. Very hard questions. Okay. They're very hard. All right. All right. Which is the one book that you'll recommend to our listeners which had the most impact on your life or on your business?
I'll give you the latest one. It's called, you've never heard of this probably. It's called Whatever Happened to Penny Candy.
Okay.
And it's by a guy named Richard Barbary. And I read it for several years ago, but I literally just reread it this year because it is the absolute best educational piece on inflation and the impacts of monetary policy on inflation, which of course we know we just came through this massive round of that. What happens, how to cure it, the causes for it, how to learn from it, whatever happened to penny candy, and a sequel book, which was The Clipper Ship Strategy, which is about how to use your investing to find what are called the codes of investment, how to find where the federal government is putting money in inflationary times. And that's where you go invest.
Yeah, I'll just
massive impact on my strategies.
Yeah. All right. Yeah, I haven't read that book, but I'll surely put it on my list. Okay. Next question. What are your main source of information to learn and grow?
I am starting to fall in love more and more with podcasts. It's kind of fun. It's like this today. We're having a conversation, and look at all the things that came out of that.
Yeah.
But I do like the Wall Street Journal still. I actually love to go over to and get the news on the U.S. from Europe. I tend to find that European news tends to be less biased and more straightforward than anything I can get here from the main sources. So yeah, I go overseas to learn about America. Go figure.
You're right in some ways, right? Because not all the medias are neutral or biased over here. So sometimes you get a real picture outside of your world. Someone who is watching it from the far distance, and giving you inputs. All right. What is the best business or investment advice you'd like to give to our listeners?
Oh man, that's easy. Be patient. Just be patient. Anybody that's telling you that real estate's fundamentally changed, you have to buy now or you have to sell now because it's never going to be the same again, just walk away from them because it's not true. Real estate, since the beginning of time, has had its ups, it's had its downs, it's absolutely cyclical. What I can't do is predict how long the cycle is, but I can sure tell you where we're at, and I recognize where we're going. And that's the key to being in place before something happens. But the way to do that, be patient. Don't stretch for it now, it'll come back.
So talking about that, right? I have a follow-up question on that one. As of now, what do you think where we are in the cycle?
This one, really interesting. We're definitely in a mature part of the cycle, right? So in the early starts of the cycle, it's so inexpensive to pick up existing construction per square foot because the construction industry is in disarray. That slowly starts to reverse to where the costs of construction are cheaper than buying existing. And then as the market starts to mature even more, that reverses again. So we're in that third part of that. As far as we're also in that late markets part where folks have transitioned from single family investing into larger and larger multifamily and commercial products to the point where the commercial real estate industry is now depressed because interest rates are costing more than they make in cap rates on the commercial property. So that's an indicator that things have matured again and they've got to be shaken up. What I don't know is whether we're really going to go all the way down. Not like 2008.
Well,
just
no,
about everybody. There's nobody holding. Very few people remember past that. There is such a thing as a normal market where it just goes down a bit, sits. Trust me, that could happen. It doesn't have to be 2008 again. But I don't know because this is an election year. And of course, everybody's promising the moon on both sides. And what's really going to happen with interest rates? It's not going to take, with all the pent up demand and the lack of supply, it's not going to take a lot of regression of interest rates to stimulate another buying boom. And as soon as that happens, you basically reset the clock on a lot of the cycle. If interest rates stay up there, and if we start to see some other things happen with monetary policy going into stagflation, recession, that could hasten coming out of the end of the cycle. I would say we're 2/3 of the way through, but honestly, it's a toss-up whether it's going to jump back up or go back down. So what's my advice? Be patient. Don't buy before the top. Don't try to buy before the top and wait to sell. Or I'm sorry, you want to make sure that you're selling your real estate before it peaks. Give up a little bit on the back end for the sake of getting out. Don't try to time it. And buy your real estate after it's bottomed. You're going to give up a little bit each way, but you're not having to worry about timing.
That's right.
That's just Dave's advice.
Yeah. And the other thing is, as long as the numbers make sense, nothing to worry about. Yeah.
And if they don't, be patient.
Yep, be patient. All right, Dave. It was a pleasure talking to you. And I'm sure we got a lot of golden nuggets out here in this podcast for our listeners. And they will surely, understand and implement.
Fantastic. It was great to be with you today. Thank you.
All right. Thank you. Take care. Bye.
Thanks for listening to Decoding Cash Flow, brought to you by Aster Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astercapital.com for more free resources. Content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cash Flow, and we'll catch you in the next episode.